We've got an earnings alert on AT&T. It's falling in the after-hour session. Let's get to Julia Boorstin in Los Angeles with the details. Julia.
Melissa, AT&T falling because it missed on revenue expectations, but it did beat on earnings, while the company raised its outlook for earnings over the course of 2018. Now, the call that is going on right now is less about results from the quarter and more about the strategy of the newly combined AT&T and Time Warner, renamed Warner Media. Take a listen to CEO Randall Stephenson.
We've now assembled the key elements of a modern media company, and it all begins with owning a wide array of premium content, because we are absolutely convinced that there is nothing that drives customer engagement like high-quality premium content. And whether it's Netflix, Amazon, Google, Disney, or Comcast, everybody is now pursuing the same thing.
In an unusual move for AT&T on this call, Stephenson was joined by all of the division heads, including Warner Media Chief John Stankey. He said they want to invest in more original premium content for HBO. Stephenson and Stankey also talked about how they're investing in advertising as well as mobile capabilities, and how all of those different investments will enable them to have a valuable direct relationship with consumers.
You take these three elements: premium content, 170 million direct-to-consumer relationships, and great ad technology, and then you combine those with our high-speed networks, and we think all of this is a game changer. Bringing these four elements together has changed the way we think about our customer value proposition. We spend our time now thinking about how to combine these elements to create unique customer experiences.
Now, as for cord cutting, the company says gains in digital streaming services such as DirecTV Now are compensating for declines in the traditional video business, saying that their new $15 Watch TV service has helped drawing in cord cutters and cord nevers. Guys, back over to you.
All right, Julia, thank you. Julia Boorstin in Los Angeles. You know what CEO Randall Stephenson said on the conference call, as well as what Julia had highlighted? We are now a modern media company. So what kind of multiple should AT&T have?
Well, I'll tell you what, it's a multiple that's at the bottom of its historical range. So if you look at it right now,
it's trading
telco, it's trading worst of the telco bunch. And whether they are losing the war in wireless, I think the wireless business, first of all, is, I think, becoming mildly less competitive. I think the short term is actually better for these guys in that front. But I think the content that they got here, especially when you look at the multiples being attached to people that have it, I don't know why these guys shouldn't be trading a higher multiple. I'm along AT&T. It's been a difficult trade for 9 months, but I'm staying in the trade.
I don't know. Does saying you're a modern media company make you a modern media company? I don't know.
That's it.
Seems to me if a lot of your revenue comes from elsewhere, maybe not.
Right.
So, you know, I'm always concerned about businesses that make a very big strategic shift. Maybe that's great. Maybe that's the right thing to do. But I think it introduces another element of risk and a balance sheet risk.
With the strategic shift, I mean, he underscores this race for content. It underscores the fact that there are many more players within the same space. Is this in part, perhaps, why Netflix is down about 11% since it reported earnings last week?
So is competition catching up to Netflix finally? I would submit no. I think clearly there is competition. I think the last quarter is more a function of the fact that they said internally it's had some accounting problems in terms of how they're looking at their metrics, and you give them a pass. Stocks still think it's going lower for a lot of different reasons. I think it trades back down to the April level, which was 305. But I'll say this. You said they're a modern media company. Then should they still have the same dividend yield that they have now if they're a modern media? I don't know. I'm just throwing it out there.
Look, I think two things. I think Karen's point's exactly right on, spot on, that there's integration risk here that people have to price in. So that's why the stock, in my opinion, is trading where it is at the multiple it's trading at. Given the dividend that this company has, I think it's a buy here. I would buy the stock, actually, for that reason alone. As far as Netflix is concerned, the competition doesn't bother me at all. I mean, this is not a zero-sum game. There are multiple venues that could exist within this sort of arena. I think Netflix has got scale, and they've got the ability.
There can be, but the market overall doesn't grow. I mean, the number of hours people can spend watching TV or watching programs is finite, in theory.
Agreed, but you look at Prime memberships. We've done studies where we've said people that have Prime memberships are more apt to have a Netflix membership, and there's a reason for that, because it's not zero-sum.
I think your point, Mel, though, is exactly why Netflix is priced way too high. I mean, there's no way that it could ever grow into that valuation. And look at HBO as a vehicle that could look a lot like Netflix. I think Time Warner's very well positioned.
Yeah, I mean, you know, the issue here is, Guy, I know you spend, what, 10 hours a day watching TV. There's only, you know, if you divide that up, somebody's going to lose, even if, you know, at the margins.
Somebody's going to lose. But who has such a head? I'm with David, although I think Netflix trades low, but who has such a ridiculous head start that it's going to be very hard for the competition to catch up with them? I think it's Netflix. Netflix shot themselves in the foot this past quarter, and I think they're paying the price. I don't think they'll make that mistake again.
But they're not getting paid on active. It's not like an active user model. I mean, it's a subscription-based model where you could not even turn it on. You're still paying your fee.
You've got to have great content. You know, I was searching through Netflix, and granted, what I want to watch is not what everybody wants to watch on Saturday night for a movie. And I got to tell you, they got a lot of Netflix-owned content. Some of it's good. Most of it, to me, is totally vacuous. And I think, you know, think about what Time Warner has. The collection of those assets is extraordinary. That and Disney, to me, are the best out there.
Well, the competition's threatening. They're not here yet. I think it was just the valuation on Netflix that was off, not so much the competitive landscape.
That's enough.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.